So now we're going to dive more into the details of labor demand and how it's derived, what it means, and so forth. So the first thing to discuss with labor demand is that labor demand is derived demand. Okay. So what does derived demand mean? Derived demand means demand for one good is derived from or depends on demand from another. Now this is not the same as complements. So if you remember complements, it means that the demands are tied together. Derived demand is a one-way street. And so with labor demand, it's derived demand because the demand for labor is derived from the demand for the product that labor is producing, the output that labor is producing. And so if there's no demand for the product, there's going to be no demand for the labor to produce it. Wages, benefits, work conditions. In a free market, we talked about how they would go to that market clearing wage, but a lot of times there's government that steps in, doesn't allow the market to be free. So you have minimum wage laws, there's pension requirements, there's firing and hiring laws. In addition, there's safety regulations and etc., all of which increase the cost of employment. And so if you think about a construction site, they have to wear hard hats, they have to go through training. Okay? All that makes it more expensive to employ someone. So there's a difference between the wage that they should be paying and the wage they should be receiving, what they do receive. So we talked about the scale and substitution effects, and the scale effect says that as wage goes up, it becomes more expensive to produce the goods, so you're going to produce less of it, and so if you produce less of it, you're going to need less people to employ. And substitution effect says that as the wage goes up, labor becomes relatively more expensive, so you're going to compare it to capital, so you're going to produce less labor and more capital. You're going to substitute the ways that produce. Okay. When you look at cost and demand, if anything happens that increases the cost to employ something, so it doesn't just have to be the wage, it can be safety requirements, it can be required training, other benefits, so forth. So anything that increases the cost to the cost to employ someone, it's going to cause the demand to go down. So in a lot of ways, when the government's trying to help workers, on this side of it at least, they're actually hurting. So this is just talking about the overall level of employment. So let's jump into profit maximization, or start to. And so the first thing with profit maximization is the idea of marginal analysis. And so at this point with economics, you've talked a lot about marginal analysis, looking at things at the margin. So for this course, we are assuming there's two ways you can produce a good, with labor and capital. Right? And some combination of the two can be used to produce the product. And so I've used the example of making a car before, but consider accounting services. Right? So in order to produce a an income tax return at the end of the year, right, you need some combination of, at least today, of accountants, labor, and computers to put everything in, to compute, to send, so forth. Right. So you need both of them. And you can, you could use all labor, or you couldn't use all capital, you can use all computers, but you could use a low amount of it if you were really putting a lot of money into it. But there's two ways to do it. So we have labor and capital. So when we look at things at the margin, right, there's two ways to look at it. So you want to look at the additional output that you're going to be getting from an additional unit of labor. Let's start there. Right. So the first thing we're looking at is the marginal product of labor. So the marginal product of labor, the MPL, is defined as the change in output, Q, from a change in labor, holding capital constant. Now this holding capital constant is important because what happens is you want to find out how much output you're getting just because you hired more labor. Okay, so if your capital is going up as well, if you're hiring more accountants, all right, so let's say you hired a new accountant and you got a new computer. All right. Well, does that mean that that accountant, any increase in output, any increase in tax terms is only because of that accountant? No. It's because of both the increase in accountant and the increase in the computer. Right. So that's why you want to hold that constant. So if you look at the marginal product of labor, it's a change in output divided by the change in labor, keeping K constant. And so if we look at an example here, let's say that, and this assumes that there's some fixed level of capital, you have labor of 0, 1, 2, 3, and 4. And at those different levels, you have 10 output, 19, 27, 34. All right, so if you have 4 people working, your output's going to be 34 units. And so to do the marginal product of labor, all right, you do the change in output. And so it's, when you go from 0 to 1 unit to labor, you get 10 units minus the 0 you had before, divided by the change in labor, which here is just 1. So you're going up by 1. You're going from 0 to 1. 1 minus 0. Right. So this marginal product of that first unit of labor is 10. So by hiring that first unit of labor, you're getting 10 additional units of output. If you do that for the second, right, output goes up by 9, labor goes up by 1. So that second unit of labor, the marginal product is 9, and then 8, and then 7. So the one thing you notice here is that this marginal product of labor is going down. So each additional unit of labor that you employ, you are getting less and less output from it. So why is that? Well, the reason has a lot to do with the fact that you have this fixed level of capital, or that you're assuming the fixed level of capital. So that capital now has to be spread out between more and more people. So consider, for example, a pizza shop. In that pizza shop, you can have one pizza oven. And if you hire one person to work there, right, well, that one person has that one pizza oven to make the pizza. If you hire a second one, right, well, while the first person may have been able to make 10 pizzas an hour, by hiring the second one, your pizza production may have only gone up by 5. Right, so it went from 10 to 15. So the marginal product of that second pizza worker would only be 5. The reason why is that they both still just have that one pizza oven to work from. All right, so they're limited by that. They're bound by that. And we call that the Law of Diminishing Returns, where each additional unit of labor you hire, you're getting less and less additional output from them. If we look at the marginal product of capital, it's the same idea. It's the change in output from a change in capital, holding labor constant. Okay? And so the marginal product of capital is the change in output divided by the change in capital, holding labor constant. Okay? So it's the, when you look at both of these, it basically tells you what you're getting by purchasing or renting that. And so, for example, the marginal product labor of the third unit of labor is 8. So it's telling you that that third worker, by hiring that third worker, you're getting 8 additional units of output from that third worker. Okay? That's what you're getting by that hiring the third worker. And the fourth worker, you're going to get 7 additional units of output. So we have the marginal product labor and the marginal product of capital. Now let's look at the marginal revenue product. Because if you're running a business, you don't care about how much output you're getting by hiring an additional worker. You care about how much revenue, how much more money you're going to make by hiring that additional worker. Okay? Because the outputs, it's a thing. But you care about the money that you're going to get from producing it. Okay? So when we look at that, you want to find what's called the marginal revenue product. And for labor, it's the marginal revenue product to labor. And so the marginal revenue product labor is the additional revenue from employing an additional unit of labor. Okay. Now this also works with capital. Now in the general case, right, so if you remember, the marginal product of labor is going to equal the change in output from a change in labor. Okay. Now, marginal revenue, if you remember, marginal revenue is the change in total revenue from the change in output. So it's the additional revenue from producing an additional unit of the good. All right. And so if you multiply these together, that's how you're going to get your marginal revenue product to labor. Marginal revenue is the additional revenue of an additional output. Marginal product is the additional output of an additional unit of labor. So the marginal revenue product of labor is going to be the additional revenue from an additional unit of labor. Now, if the product market is competitive, and so if you recall back to economics, your micro courses, competitive market is where you have a lot of buyers and a lot of sellers, and when that's the case, the price is set by the market. So there's just one price. And when there's one price, that price equals the marginal revenue. So that's the revenue side. Again, we're looking at things in the margin. And so when we are looking at marginal analysis, you don't just look at the revenue side, you have to look at the expense side. So you have to look at the marginal expense, the additional expense of adding an additional unit of an input. So the marginal expense of labor is going to be the additional expense. All right, so what's going to cost of employing an additional worker. Okay, and so if it's a competitive labor market, the marginal expense of labor, all right, remember we talked about the competitive market, is going to equal the wage. That's where you have that horizontal supply curve, because there's one wage, it's that market clearing wage, and that's what ends up getting used.